In today's episode, I'll talk about two interesting stories. In the first one of the day, I'll talk about how Pakistan's solar boom is completely changing its power sector and also why it is now creating a very new kind of energy crisis. And in the second story of the day, I'll talk about how practically India's entire energy future hinges on one underrated metal, which is copper, and whether we are doing enough to secure it. Welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 8th of July. See, most of the times on this show, we tend to stick to those stories which are directly connected to India. But the thing is, every now and then, we also come across a global story that just feels so important or rather too interesting in some cases to ignore. Now, this one that I'm talking about today is a bit of both of these things. Now, this is about a country that rarely makes it to the center of energy discussions, and yet it is going through one of the fastest solar transitions in the entire world. That country, ladies and gentlemen, is Pakistan. Now, the headline that got us curious about this was from Reuters, which said, and I quote, "Pakistan's solar revolution leaves its middle class behind." Now, I know at first look that feels a little bit ironic. Solar power is one of the cleanest, most decentralized and democratized forms of energy. It is cheaper than fossil fuels, it is scalable across rooftops, and it also promises long-term independence from volatile global prices. So the question is, how does something so promising end up becoming such a big problem, especially for a country that might require it quite a bit? To understand that, let's first understand how Pakistan's electricity sector has been for many decades now. See, Pakistan is a densely populated country, as you might know, but the thing is, they never managed to build enough power generation to meet their demand. Until the early 1990s, electricity generation was run entirely by the public sector. The thing is, most of these government-run power plants were inefficient, they were outdated, and they were also very prone to breakdowns. They also consumed a lot of fuel, but they could still not provide reliable electricity. So therefore, in 1994, Pakistan decided to open the sector up to private and also foreign investment. But the thing is, in order to attract investors, the government made a bunch of risky promises. They guaranteed returns to power producers in US dollars and not in Pakistani rupees. They also assured full payment even if the electricity was not used to full capacity. Now, these were basically known as take or pay contracts, which is where the government was required to pay power producers whether they actually generated and sold electricity or they did not. They also offered full sovereign guarantees, which basically meant that if discoms did not pay the producers, the government would step in and pay from its own pocket. Now, of course, at that point in time, this might have sounded like a bit of a shortcut to bring in some capital. But the thing is, over the years, these decisions turned into long-term liabilities. Pakistan got locked into high-cost power contracts, which were mostly priced in US dollars. And while generation increased for sure, the country did not invest enough in transmission or distribution infrastructure. So even if there was enough electricity that was being produced, large parts of it would be lost during transmission or they would simply not reach where it was required. And that created what is now widely known as Pakistan's circular debt problem. Now you can think about it like this. The cost of electricity was too high for common citizens to afford, and yet the service remained unreliable. And because people were frustrated with blackouts and high prices, many of them did not end up paying their full electricity bills. And as a result of that, discoms did not have enough money to pay power producers, but the government had guaranteed those payments, so therefore they had to keep bailing them out. And this debt then eventually kept building up, going around in circles, and it worsened every single year. Now, by the time the Russia-Ukraine conflict broke out in 2022, global energy prices had already begun rising. But for Pakistan, the situation quickly turned into a full-blown crisis. The country imports most of its fossil fuel, and the war caused massive supply disruptions and price spikes. And on top of that, as a condition of receiving a $6 billion loan package from the International Monetary Fund, Pakistan was asked to increase electricity tariffs. Now, that was meant to fix the financial mess in the power sector and help the government reduce its circular debt. But the thing is, in reality, it actually pushed electricity prices even higher for ordinary people. To give you a reference, between 2021 and 2024, electricity tariffs in Pakistan rose by more than 150%. In some cases, it became more expensive to power power a home than actually to rent one. That's pretty crazy. And when that happens, people naturally start looking for alternatives. That is when solar panels entered the entire picture here. Now, globally, the solar market has been seeing an oversupply right now, especially with cheap Chinese made panels that are flooding over the market. Now, this basically made solar technology much more affordable than it has ever been before. And in Pakistan, obviously, people were desperate for electricity. So they didn't just switch to solar because it was trendy or green, they switched because it was the only viable option that was left for them. And the shift, mind you, was massive. By 2024, Pakistan had imported close to 22 gigawatts of solar panel capacity, which is mostly for rooftop use. And if I were to put that number into context for you, that is nearly half of Pakistan's entire installed electricity generation capacity. And the most interesting part is that all of this happened without a centralized government-led solar program. It was all the people themselves who decided to stop depending on grid and take control of their electricity in their own hands. There were other factors that helped as well, mind you. Back in 2015, Pakistan introduced a net metering policy, which basically allowed solar users to sell excess electricity back to the grid at retail rates. So for example, if your house generated more electricity than it used, you could make money off it by selling it away. Now, if you combine that with the absence of any major import duties on solar panels, the financial case for a rooftop solar became very, very attractive. But this is also where things started getting a little bit complicated. See, electricity grids are built for scale in general. They are designed to serve millions of people in a centralized and predictable way. That's how, by the way, the costs stay reasonable because the fixed costs of generation, transmission, and distribution are spread across a large number of paying users. But the thing is, when that scale breaks, which is when wealthier users exit the system, the math suddenly starts falling apart. And that is exactly what is right now playing out in Pakistan. The richest households who paid the most amount of money for grid electricity are suddenly leaving the grid system altogether. That means that the burden of paying for the fixed cost of electricity infrastructure is falling on smaller, poorer group of users, which are people who cannot afford to install solar panels, but they still rely on the grid. Now, these users are now left to cover the cost of not just their own electricity, but also the expensive take or pay contracts that the government had signed many years ago. And to remind you, these contracts do not care about actual consumption. Whether or not people use electricity from the grid, the government is still obligated to pay the power producers. So even though solar is reducing demand from the grid, the cost of that unused electricity is still very much there. And it is being passed on to whoever is left on the system. That, ladies and gentlemen, is the invisible price of defection. Basically, when enough people leave the system, the ones who stay are left with higher and higher bills. And that's what the Reuters headline meant when it said that the middle class is being left behind. The poorest already struggled with electricity access, but now even the lower middle and middle income households are feeling the squeeze here. Like I said, many of them cannot afford solar, but their bills are still going up anyway because they are the ones who are footing the bill for a shrinking grid. Now, the thing is, instead of addressing the root problem, like renegotiating those expensive contracts or redesigning the grid for a decentralized future, the government has started penalizing solar users. In 2025, it slashed the net metering buyback rate from 27 rupees per unit to 10 rupees per unit, which makes it far less lucrative to sell electricity back to the grid. And now they are also considering a fixed monthly fee for solar users, which is basically charging people just so that they can remain connected to the grid even if they use very, very little electricity. Now, this approach, mind you, is not unique to Pakistan. California had tried something very, very similar. When rooftop solar adoption increased, utilities there also started pushing for what some people called a solar tax, which is a fixed charge to make up for lost revenue. But this strategy also ended up slowing down the solar transition and disproportionately hurted low and middle income households. Now, in Pakistan's case, the risk is even more serious. If current trends continue further, the entire grid-based electricity model could sort of collapse into what experts call a utility death spiral. You would have gotten the drift by now. The more the people leave, the more expensive it gets for those people who remain, and that forces even more people to leave, which only worsens the entire spiral and almost gets everybody out of the system. Now, eventually, the grid becomes financially unviable for both the providers and the users. There's one quote that sums up the entire situation very, very well. Dattatreya Das from Ember Energy says, and I quote, "Though penetration of rooftop solar can raise concerns around the financials of discoms, these trends are only already expected to grow further. The traditional model of discoms managing electricity supply in a centralized one-way fashion will increasingly be questioned. The shift towards a platform operator-based model is inevitable. In other words, he says that the world is changing right now. The old model of a top-down centralized electricity generation and distribution is being challenged by new decentralized technologies like rooftop solar, and unless countries, especially by the way those who are in crisis, start building policies that reflect this very shift, they will risk ending up in systems that punish the poor, reward the risk, and ultimately fail to serve anyone very well. So basically what started as a survival response by ordinary Pakistan citizens, which is trying to keep the lights on during an energy crisis, has now suddenly turned into something that's much, much bigger. So this is a lesson in what happens when systems that are built on fragile economics collide with rapid technological shifts. So while at first solar energy might have seemed like the perfect fix, it is now suddenly exposing deep fault lines in how we think about infrastructure, equity, and also the future of energy. That brings me to the end of the first story of the day. Let's now move on to the next story and talk about copper. Now I know copper may not seem like the most exciting topic at first, but the thing is, if you look a little bit closely at what India is trying to do in the next 2 decades, whether it is building renewable energy, expanding electric vehicles, or simply wiring up a modern economy, you will suddenly start to see why this shiny red metal matters so much to all of us. I'll explain. See, a few days ago, the Ministry of Mines quietly released a vision document for India's copper sector. And it actually is a pretty big deal because this is not just about a single commodity, it is about whether India will be able to keep pace with its own ambitions. I'll start from the very beginning to explain what's exactly going on. See, to give you some quick context, copper is currently one of the most essential materials in the modern world. You'll find it in power grids, in solar panels, in wind turbines, electric cars, mobile phones, and even basic plumbing and building infrastructure. So as India moves towards a cleaner and a more connected economy in general, copper becomes very central to that entire journey of ours. And the government of course knows this, and that is why copper has now been officially listed as one of the 24 critical minerals under the MMDR Amendment Act 2023. To explain that in very simple language to you, this means that we consider it so important that we cannot afford to run out of it, or for that matter rely too heavily on others for it. So the question then becomes, what is the current situation that we are in right now? See, today India uses about 1.7 million tons of copper every single year. But the interesting part is how uneven that number is when you compare it globally. The average Indian uses just 0.5 kg of copper in 1 year. A German, on the other hand, actually uses 14 kg, and a South Korean uses about 11 kg. So if you think about it, in terms of pure copper consumption, we are still way behind, and that tells you just how much headroom there is for growth. And that growth is coming as well. The new vision document projects that copper demand in India will double by 2030 from about 1.7 to over 3 million tons. And by 2047, which is when India celebrates 100 years of independence, we need close to 10 million tons of copper every single year. That is almost a 6 times jump in demand from where we are at today. Now you might be asking, why such a sharp increase? See, that is because copper demands tend to grow hand in hand with GDP. But in a country like India, where a lot of basic infrastructure still needs to be built out, that demand actually grows much faster than the economy itself. Economists also have a word for this, which is called elasticity. And the document actually breaks this growth into 2 phases as well. In the first phase, which is now till 2030, copper demand will be what it is called GDP elastic. That basically means that it will grow faster than the GDP itself. For every 1% increase in GDP, copper demand could rise by about 1.1 to 1.3%. And like I said, this happens because India as a country is still building its foundations. To understand this a little bit better, think about our country as a house. See, when the house is under construction, when you are wiring it, plumbing it, installing systems, etc., you obviously need a lot of raw material. That is where India is at right now. Every new metro line, every new housing block, every new EV charger, or a solar farm for that matter, all requires copper. And when you're catching up with decades of underbuilding, demand obviously has to spike very quickly. But the thing is, as per projections, after 2030, things will begin to settle. The elasticity would drop between 0.6 and 0.7, which means copper demand will still grow, but it will be slower than the growth of GDP. Now, I know that might sound like a bad thing to some of us, but it is actually a sign of good maturity. And there are 3 big reasons why this shift even happens in the first place. See, first is that you've built the core infrastructure, which which includes stuff like highways, grid lines, power plants, etc. And you don't keep rebuilding them every single year. You basically only need to maintain or upgrade them, so therefore your copper needs flatten out to quite an extent. The second reason is that technology becomes more and more efficient. For example, an electric vehicle in 2015 used to use 99 kgs of copper, but by 2030, that number is actually expected to drop to 62 kgs thanks to better designs and also smarter engineering. And the same efficiency improvements are happening across power systems, appliances, and also electronics. The third reason is that recycling starts to come into the picture. See, the copper that gets installed in infrastructure today will eventually come back into the system as scrapped in about 15-20 years. And once recycling becomes mainstream here, we'll need less fresh copper from mines every single year. But that said, even with the slower pace, the absolute numbers are still absolutely massive. I'll give you an example to explain this. A 13% increase today on a base of about 1.7 million tons adds around 220,000 tons of new demand. But a 6% increase in 2047, which is when the base will be around 9 million tons, will add about 540,000 tons. So that said, if the percentage slows down as well, the actual tonnage that we will require every year will still keep getting bigger. And that brings me to the real problem, which is supply. See, the problem is that India does not mine much copper. In FY 2024, we produced just about 509,000 tons of refined copper. That's not even about a third of what we require. And the most worrying part is that this number has been falling. Back in FY 18, we were producing 843,000 tons. So in short, while our demand is surging, our domestic production is actually going backwards. So the question is, what do we do? The answer is we import, and a lot of it. Today, more than 90% of India's copper requirements is met through imports, either in the form of copper concentrate, which by the way smelters refine, or in the form of fully refined copper and scrap. And about 2/3 of our raw material imports come from just 3 countries, which are Chile, Peru, and also Indonesia. Now that obviously is a very risky situation to be in. One policy change in one of these countries or any supply disruption can throw out our entire supply chain off balance. It already, by the way, happened once, which is when Indonesia banned copper concentrate exports in order to boost their own domestic industry. India at that point in time had to scramble to find alternatives. And apart from the supply risk also, by the way, there is also the money angle here. Our copper trade deficit, which was $760 million US in 2017, has now ballooned to over $6 billion US in 2023. And every time copper prices go up globally, India ends up spending more of its forex reserves. So the big question then is, what's really the plan here? See, the government's new vision document lays out a fairly ambitious roadmap, and it starts with fixing how we explore for copper. See, right now, India barely scratches the surface when it comes to geological exploration. So in 2023, the government introduced a new type of permit which is called exploration license. Now this allows private players to explore blocks of up to 1,000 square kilometers for 3 years with a possible 2-year extension as well. Now the idea here is very simple. Let more players search for copper, not just government agencies. Then there is also recycling, which is becoming a very important part of the supply strategy. See, today about 38% of the copper that India consumes is from recycled scrap itself. Now that includes old wiring, electronics, industrial wastes, and anything that can be melted down and also reused. But again, most of that happens in the informal sector with little to no regulation whatsoever. Now the government now wants to formalize this as well. They want to bring in quality checks, safety standards, and also formal recycling infrastructure. A few policy nudges for this are already in motion right now. The reverse change mechanism, which was introduced in 2024, makes the buyer responsible for paying taxes on scrap purchases, which basically helps reduce evasion. Then quality control orders are also being pushed to ensure that copper products meet Indian safety and performance standards. And then there's also the talk of restricting the export of high-grade copper scalp so that we can keep the good stuff within the country instead of having to send it abroad. There's even an idea to create a strategic copper reserve, much like we do for oil. Now this could take the form of physical stockpiles or reserves of recyclable copper so that they could safeguard against global supply shocks. But all that said and done, the government also knows that domestic exploration and recycling alone will never be enough. So they are now doing what China did more than about a decade ago, which is going global. See, since 2010, China has invested more than 16 billion US dollars to acquire stakes in copper mines around the entire world. India, through a public sector company called KABIL, is now trying to follow that same model. The company is basically tasked with acquiring overseas mining assets, which can help secure long-term supplies of key minerals, including copper. We are also negotiating trade deals with copper-rich countries countries like Chile, Peru, and also Australia with copper-specific clauses in mind. And all of this, which is exploration, recycling, imports, and trade, is all being done with one single goal, which is to build 1 million tons of new capacity by 2030 and another about 3.5 million tons by 2047. That's almost building an entire new copper industry from scratch. And it's not just the government, private companies are throwing their best hat in the ring as well. Adani is investing $1.2 billion to build what will become the world's largest single location copper smelter at Mundra Port in Gujarat. And when it's complete, it will double India's current copper refining capacity. Vedanta, JSW, and Hindalco are also stepping in here. JSW, for example, has announced a 5 lakh ton facility in Odisha. Hindalco is expanding and pushing deep into recycling, and Vedanta is looking to restart operations across multiple different locations. Each of them is placing billion-dollar bets that India's copper hunger will keep rising for the next 20 years or so. So the question then after all of this is, where does this all leave us? See, right now, India is a copper-starved country, so to speak, where we are trying to build a copper-rich future. Mind you, we are still very, very dependent on imports, and our domestic mining and refining base is still very small. But the good news is that we are moving with policy changes, private investments, and a long-term vision to turn copper from a bottleneck into actually a strategic strength of ours. Now, of course, whether we succeed or not will really depend on how fast we can act and how well we can coordinate between the government, the industry, and also global partners. Because if India has to be serious about becoming a clean, connected, and electrified economy, there is absolutely no future without copper, at least as of today's technologies. And that brings me to the end of the two stories of the day. On that note, let's move on to the final section and talk about the quick news headlines. First, we've spoken about nuclear energy several times on this show because it is very, very fascinating. And it's also increasingly important, as we can see through this latest update. See, the Indian government is planning major changes to its nuclear power laws like the Atomic Energy Act and the liability norms so that they can let private companies handle areas now controlled by the state like mining, exploration, and fuel fabrication. Second, India has moved imports of gold compounds, which are used in tiny but essential parts of electronics like circuit boards and semiconductors, from an unrestricted to a restricted category, causing custom delays. This new restriction comes on top of earlier China-led curbs on rare earth magnets and could potentially disrupt India's Make in India electronic growth plans. Third, a few weeks ago, we had covered Samsung's legal dispute with the Indian government over its e-waste rules, and now looks like Samsung has some company. US air conditioning firm Carrier's Indian unit has joined Samsung, LG, Daikin, Voltas, and others in suing the Indian government over new e-waste rules which mandate higher recycling fees per kg. Now, the companies argue that the 22 rupees per kg minimum charge unfairly raises costs, while the government says that it's needed to boost formal recycling and tackle India's growing e-waste problem. Fourth and the final one for the day, Reliance Retail has picked up a minority stake in UK-based skincare and facial fitness brand called Face Gym. As part of the deal, they plan to launch Face Gym studios and set up dedicated sections in its Tira beauty stores across India over the next few years. That's all the news and stories I have for you today. I hope you enjoyed this episode. I'll see you in the next one. This is your host Anurag Bansal signing off. Take care and have a nice day. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.